Imagine waking up one morning, checking your investment portfolio, and realizing you have made more money while you slept than you did at your 9 to 5 job. Sounds unreal, right? Well, that's exactly how smart investors grow their wealth, by letting their money work for them. The stock market is how millionaires and billionaires build their fortunes. And in today's video, I'm giving you a step-by-step, beginner-friendly guide to investing, from choosing your first stock to building long-term wealth. By the end of this masterclass, you'll have everything you need to start investing with confidence, even if you have zero experience today. So grab a notebook, hit that like button for the YouTube algorithm, and let's dive in. The stock market is a place where investors buy and sell shares of publicly traded companies. Think of it like a giant marketplace where companies raise money and investors get a chance to own part of a company. Companies like Apple, Amazon, and Tesla all became billion-dollar giants because investors believed in them early on. When you invest in a company, you're literally owning a piece of it. Inflation destroys savings. If you keep £10,000 in the bank today, it won't buy the same amount of goods 10 years from now. But if you invest it wisely, it can grow into £50,000 or more. Compound interest is the key to wealth. Warren Buffett started investing at 11. If he had waited until 30, he would have missed out on billions. Investing isn't about getting rich overnight. It's about getting rich for sure over time. Investing is only for the rich. False. You can start with as little as £1 with fractional shares. Stock market investing is gambling. Also false. Gambling is luck-based, whereas investing is strategy-based. You need to be a financial expert. Absolutely false. With the right intent and dedication, anyone can learn. I learned without any financial background. If you're watching this video, you're already ahead of 90% of people who never invest at all. Now let's look at few investment terminologies. Number 1, stock, a share of ownership in a company. Portfolio, your collection of stocks and investments. ETF, or exchange traded fund, a basket of stocks you can buy in one go. Dividends, payments some companies give to shareholders. Bull market versus bear market, when stocks go up versus when stocks go down. Don't worry if you don't remember all of this yet. By the end of this video, it will all make sense. Now we are looking at types of stocks. Growth stocks, high potential but risky. Value stocks, undervalued and stable. Dividend stocks, pays you passive income. Blue chip stocks, large, reliable companies. A strong portfolio is like a good team. You need a mix of different players. Now we are looking at stock exchanges and how they work. The NYSE, New York Stock Exchange, and Nasdaq are the biggest exchanges in the US. London Stock Exchange in the UK, BSE and NSE in India, and so on. Stock prices move based on supply and demand, company performance, and market sentiment. Now that you understand the basics, we will proceed with how to choose the right stocks and build a winning portfolio. This is where things get exciting. If you're finding this video helpful, hit the like button and drop a comment below. What's your biggest investing fear? Did you know that over 90% of new investors lose money in the stock market? Not because stocks are bad, but because they don't have a strategy. Today, I'll teach you how to pick the right stocks, avoid beginner mistakes, and build a winning portfolio. By the end of this section, you'll exactly know how to research stocks like a pro and invest with confidence, even in a market crash. So what is active versus passive investing? Active investing is picking stocks yourself. High risk, high reward. Passive investing is investing in ETFs or index funds and holding long term. Which is better? Studies show that 90% of fund managers fail to beat the market. Best for beginners, start with passive investing, ETFs, and then add stocks over time when you understand stock market more. Now let's talk about long-term versus short-term investing. Short-term investing, also known as trading, day trading, swing trading, options trading, high risk. Long-term investing, buying great companies and holding for years, proven to build wealth. Real example, if you invested $1,000 in Apple stock in 2000, it would be worth over $500,000 today. The best investors aren't traders, they are patient. Now let's discuss about index funds versus individual stocks. Index funds like S&P 500 invest in 500 plus companies at once. Individual stocks, higher potential but requires really good research. Best for beginners, start with index funds, then buy individual stocks once you learn. Even Warren Buffett recommends index funds for most people. Now let's talk about a really important aspect of stock investing, how to research a stock before buying. Number 1, company overview. What does the company do? Is it profitable? Number 2, revenue and profit growth. Are earnings increasing? Number 3, P by E ratio and valuation. Is the stock overpriced? Number 4, debt levels. Too much debt equals to high risk. Number 5, competitive advantage moat. Does it have a strong brand? Number 6, leadership. Good CEO and leadership and good corporate governance generally equals a strong company. If a company is making more money every year, has little debt, and is dominating its industry, it's usually a great investment. Now let's look at fundamental analysis versus technical analysis. Fundamental analysis is looking at financial statements and the fundamentals of a company, best for long-term investors. Technical analysis, studying charts, trends, and indicators, best for traders. Now, which one should you use? For beginners, focus 80% on fundamentals and 20% on technicals. As Warren Buffett said, I never buy a stock based on a chart. I buy great businesses. So now you know how to research stocks, but how do you build a risk-proof portfolio? In the next section, I'll show you how to protect your investments, diversify your portfolio, and invest through a market crash. So if you're enjoying this so far, smash that like button and subscribe. Most investors in general panic when the market crashes. But did you know that some of the richest people in the world make their biggest profits when the market is down? In this section, I'll show you how to protect your money, reduce risk, and build a bulletproof portfolio. By the end, you'll know exactly how to invest safely even if the market crashes tomorrow. Every investment has some level of risk, but higher risk can mean higher rewards. Examples of different risks. Investing in Amazon in 2000, high risk, high reward. Investing in Coca-Cola, low risk, steady growth. Rule number 1, never invest money you can't afford to lose. The key isn't avoiding risk, it's managing it. What is diversification? Spreading investments across different assets to reduce risk. Best way to diversify? Stocks across industries, tech, healthcare, energy, etc. ETFs and index funds, S&P 500, Nasdaq 100. International markets, emerging markets. Someone who only invested in tech stocks in 2022 lost 50% of their money, while a diversified investor only lost 10%. Think of your portfolio like a team. You don't want only strikers. You need defenders too. Now let's look at dollar cost averaging or DCA. Investing small amounts over time to reduce risk. This is also known as SIP or systematic investment plan. Best for volatile markets, helps avoid bad timing, for example buying at the peak. Lump sum investing, putting all your money in at once. Historically better if the market keeps going up. Which one should you use? Beginners start with SIP or DCA as it's called in the US. Experienced investors can use lump sum for undervalued and really well researched stocks. Even the best investors don't try to time the market, they focus on consistency. Emotions are the number one reason investors lose money in the stock market. Let's look at a few of the common psychological traps. FOMO, fear of missing out. Buying stocks because they are hyped. Panic selling, selling stocks when they drop instead of holding. Overconfidence bias, thinking you are smarter than the market. How to stay rational. Ignore short-term news. Focus on company fundamentals, not stock price movements. Have a clear investing plan. How to set realistic investing goals. Short term, for example, I want to grow my portfolio by 10% per year. Long term, I want to retire with $1 million by investing, let's say, $500 every month. Exit strategies. Sell when the company's fundamentals change, not just because the stock dropped. Take profits in stages, selling, let's say, 20 to 30% at a time. You can also use stop loss orders to limit potential losses. A goal without a plan is just a wish. So set clear, achievable investing goals. Now you know how to manage risk and build a portfolio that can survive any market condition. But how do you actually start investing today? In the next section, I'll walk you through opening a brokerage account, placing your first trade, and growing your wealth. If you're finding this helpful, hit the like button and subscribe. Alright, we have covered the basics, strategies, and risk management. Now it's time for the most exciting part, actually starting your investing journey today. In this section, I'll walk you through how to open a brokerage account, place your first trade, and build your portfolio step by step. By the end, you'll be ready to invest with confidence. What is a brokerage account? It's an online account that lets you buy and sell stocks. Think of it as your stock market bank account. How to choose the best brokerage? If we just talk about the US market, for beginners, Robinhood, Fidelity, they are pretty easy to use. For advanced investors, Interactive Brokers, which have got more tools, for example. And for international investors, eToro, for example. Key factors to consider while choosing a brokerage: fees and commissions. Zero commission brokers are the best. Ease of use, beginner-friendly interface, available stocks and ETFs. Some brokers don't have global stocks. Pick a broker that fits your needs and then stick with it. Long-term investing is about consistency. How to open and fund your brokerage account? Generally, it's very easy. Sign up online, use your email, create a secure password, verify your identity, maybe upload ID for security, link your bank account to deposit money, fund your account. Start with as little as £10 or $10, as much as you want. Most brokerage accounts take 24 to 48 hours to approve, so start this process now. Right, now let's look at the order types. Market order, buys at the current price. Limit order, buys at a specific price you set. Stop loss order, sells if the stock drops below a certain price. Now, step-by-step process to buy your first stock. Search for the stock, example, Apple. Number 2, click buy and choose how many shares you want to buy. Number 3, select market order for instant purchase. Number 4, confirm your order. Boom, you just made your first investment. Welcome to the stock market. Now, how to monitor and manage your investments? If you ask my suggestion, looking daily at your portfolio isn't a good idea. Maybe weekly, unless you're trading. Avoid panic selling. Set alerts for price movements. Use research tools like Yahoo Finance, Google Finance, Seeking Alpha. Reinvest dividends for compound growth. Remember, the stock market rewards long-term patience, not short-term emotions. Now let's look at the types of investment taxes. Capital gains tax, taxes on profits from selling stocks. Dividend tax, taxes on dividend payments. There are tax advantaged accounts like Roth IRA, 401k, ISAs for UK investors. Now, what are the common mistakes beginners make? Number one, panic selling when stocks drop. Investing all money in one stock, very high risk. Chasing hype stocks based on news. Not reinvesting dividends, missing out on compound growth. So, now you know how to open an account, buy stocks, and manage your portfolio. But what if you want to take things to the next level? In the next section, we will cover advanced investing strategies, dividend investing, options trading, and even how to profit in a market crash. So if you're loving this, hit the like button and subscribe. What are dividends? Payments companies make to shareholders quarterly or annually. Example, Coca-Cola pays dividends every year since 1920. Perfect for passive income investors. How to find the best dividend stocks? Now, you could look at dividend yield. Look for 2 to 5% yields, not too high, not too low. Dividend growth. Choose companies increasing dividends every year. Dividend payout ratio. If it's over 70%, the company may not sustain it. With a good dividend portfolio, you can eventually live off passive income from your investments. Now let's understand what is value investing. Buying undervalued stocks and holding for the long term. The strategy used by Warren Buffett to become a billionaire. Now, how to find undervalued stocks? Generally, look out for low PE ratio, less than 20. Stock might be cheap that way. Price to book ratio, P by B, look for less than 3. Strong financials, growing revenue, low debt. In 2008, Amazon was only $40 per share. Many ignored it, but value investors saw its potential. Today, it's worth over $3,000 per share. Great investors buy stocks when they are on sale. Now let's understand what is growth investing. Buying fast-growing companies that could become industry leaders, and how to find high-growth stocks. Revenue growth, look for 30+% yearly growth. Strong leadership, a visionary CEO, innovative business model, changing industries like AI, EVs, cloud computing. Let's look at some of the examples of past growth stocks. Amazon, e-commerce, Tesla, electric vehicles, Nvidia, AI and chips. Growth stocks are risky but can turn small investments into huge numbers. Options trading. What are stock options? Contracts that let you bet on stock prices going up or down. Call options is betting the stock will rise. Put options is betting the stock will fall. How can beginners use options? Covered calls, earn income from stocks you already own. Protective puts, protect your portfolio from crashes. Options can be powerful, but only use them if you understand the risks. What is short selling? Borrowing stocks, selling them high and buying them back lower. Example, if Tesla is $1,000 and you short it and it drops to $500, you make a profit. Who should use short selling? Only advanced investors who understand it. Short selling is very high risk. Instead, use inverse ETFs like SQQQ to profit in downturns. You don't always have to fear market crashes, you can profit from them too. Now you know how to earn passive income, find the best stocks, and even profit in a market crash. But how do you put all of this together into a winning strategy? In the final part, I'll show you the ultimate stock market roadmap. a step-by-step plan to go from beginner to pro. So make sure you hit like and subscribe. Step 1. Learn the basics. Watch educational videos like this one. Read books like The Intelligent Investor by Benjamin Graham. Understand how stocks, ETFs, and dividends work. Step 2. Open and fund your brokerage account. Choose a beginner-friendly broker. Deposit your first £100 to get started. Step 3. Start with ETFs. Invest in broad market ETFs like S&P 500 if you're in the US, and different kind of ETFs in different countries. Avoid picking individual stocks too soon. Step 4. Set up a monthly investing habit. Invest, let's say, £100 per month consistently. Use the SIP method, or if you're in the US, the dollar cost averaging method. Avoid market timing mistakes. Track your portfolio with Google Finance or Yahoo Finance. The goal in this stage is to build confidence and get comfortable with investing. Step 5 is where you can start picking individual stocks after obviously doing your own research. Look for strong companies with growing revenue and profits. Use fundamental analysis, P by E ratio, earnings reports. Invest in blue chip stocks. Step 6. Diversify your portfolio. Balance your portfolio with 50% ETFs, 30% individual stocks, different sectors, tech, healthcare, finance, etc. 10% dividend stocks for passive income, 10% cash or bonds for safety. Step 7. Reinvest profits and stay patient. Don't cash out early, let compound growth work. Reinvest dividends to grow wealth faster. Avoid emotional investing. No panic selling. By now, you should have a portfolio of solid stocks and ETFs growing steadily over time. Step 8. Explore advanced strategies. Start options trading if you want covered calls for passive income. Try short selling in market downturns. Use stop loss orders to protect profits. Step 9. Build a dividend income stream. Focus on high quality dividend stocks, 3 to 5% yield. Reinvest dividends for exponential growth. Target a portfolio that pays $1,000 per month in dividends. Step 10. Achieve financial freedom. Keep investing consistently even in market crashes. Reach a portfolio size where you can live off investments. You might be in a position to consider retiring early with the FIRE movement. This is the stage where investing turns into real financial freedom. Stay consistent, invest every month, no matter what the market does. Keep learning, follow market news, read financial reports, ignore the hype. Focus on fundamentals, not social media trends. Think long term. The best investors hold for decades, not days. The secret to success isn't timing the market, it's time in the market. Congratulations, you now have a complete roadmap to mastering the stock market. Whether you are just starting or aiming for financial freedom, follow this plan and stay consistent. If you found this valuable, hit like, subscribe, and turn on notifications. Drop a comment below on what you found most useful. I reply to every comment. Now go start your investing journey and build the wealth you have always deserved.